In this video we're going to be looking at rising and falling wedges, and some of the objectives discussed in the video include identifying such occurrences, identifying the points where the pattern's complete, and deriving the one-to-one minimum price projection targets to put some of this theory into action rather. So let's begin. A rising wedge is a bearish pattern, and they form when price oscillates between two converging trend lines. And you may think that if we bring up a pattern really quickly here, this pattern might seem to look similar to a bearish flag pattern. Well, the first key difference here is that for a pattern to be considered a bearish flag, the symmetrical triangle must form after a rapid decline. For a rising wedge though, as we have here, it can form anywhere and is always intrinsically bearish. It can occur after a decline, an advance, or a consolidation and still be bearish. So note that a pattern of a rising wedge is always intrinsically bearish. That is what we must remember in comparison to anything else. And the second key difference between that and an example such as a bearish flag pattern, as we've made a video about, is that both trend lines must be ascending for a rising wedge. So look at this example, both trend lines are ascending and both should be pointing up as a result of that, with the lower one rising at a steeper gradient, which means that this is rising at a faster rate than the trend line on top of it. And in the symmetrical triangle, which occurs in flags, the trend lines are pointing in different directions. So one could be rising, say this bottom one could be rising and the top one could be falling. But that's not a rising wedge. You need both to be rising, both trend lines to be rising for you to have a rising wedge. And this pattern is confirmed as soon as the trend lines are established. There is no breakout requirement for the pattern to be considered complete. You've got the establishment of these trend lines here, and that means the pattern's complete. You don't need the breakout for it. And with regards to volume, volume would decline throughout the wedge whilst it's consolidating to lower levels, and then as the breakout occurs, you would get an expansion of volume. So let's have an example here with a rising wedge forming at the end of a strong advance. I'm quite a fan favorite, should we say. Eastman Kodak, the company that has been in the media as of recent for an apparent deal with the US government for $750 million, I believe, to develop drugs instead of cameras, which seemed to be their previous focus of business. But hey, let's focus on the situation here. We have that rising wedge here, shown by what we just discussed. The price broke out to the downside around here, and that was just as the trend lines started to converge. Converge basically means that they are getting closer together, and eventually they will cross over. These trend lines will cross over each other, and that convergence will be complete. But to calculate a minimum one-to-one projection target, you would measure the vertical distance of the base of the wedge, and that is the height between the two trend lines at the time when the wedge begins. So this is where the wedge has begun, and that's where you would get your height difference, and then you would project this height difference that we've shaded from the point of breakout to get your one-to-one target. And it's interesting to see that in this instance, the decline after the breakout went down to the one-to-one target, where it started to consolidate around here and form a base. And we should probably note for volume 2, we've added a little graphic here where there was declining volume as the pattern was forming, as you had a kind of a wedge pattern forming. And there was a further sign that there was a bearish outcome too, of when you had the break, you had volume increasing in line with the pattern occurring, which is also a way that we can confirm the bearishness being in place. So with a falling wedge, on the other hand, we must remember that this is a bullish pattern. This is where both the trend lines are pointing downwards or descending. And just like the rising wedge, it doesn't matter where it forms, after an advance, decline, or consolidation, it is always intrinsically bullish. Remember, rising wedges are bearish, always bearish, and falling wedges are always intrinsically bullish. So let's give a quick kind of pattern drawing here in the Quantium Research colors. And the pattern completion here comes as soon as the trend lines are established. Just like before with rising wedges, a falling wedge is complete when you have the trend lines established. And then the price would be expected to break out to the upside, and price targets can thus be generated after that. And with regards to volume, you would expect to see the same pattern as before followed, where we'd mentioned with the rising wedge, you'd have a contraction as the wedge forms, and then an expansion of volume, more volume as the breakout occurs. A lot of people are involved, probably trying to go long on this setup kind of thing. That's where you would have on the break a lot more volume. So let's get an example here with a falling wedge coming at the end of a large downtrend. And this is on Bank of America shares. We've got a daily chart. Each candle here represents a day, just for reference to make things as clear as possible. So we use the same method as we mentioned before to find the minimum 1-to-1 target, and that measures the base of the wedge. This is where the wedge begins. You get the height, and then you get the highest point and the lowest point, and you work out that difference, and that's the shaded area as we've pointed out here. And you would project that upwards from the point of breakout, where we've seen a breakout under this falling wedge circumstance, and you can see that you expand that point from the point of breakout, you get your 1-to-1 target, and that was met and also exceeded in this example. Interestingly enough, straight after, it's kind of an area of support too. And again, volume confirmed the pattern. You see volume was contracting as the wedge was kind of forming, and as it developed after that gradual decline situation, you had a breakout of volume when the breakout occurred here. You see the point where we have this falling wedge occurring, price breaks above there, and that's where volume seems to be trending higher as well. So to conclude, wedges are really popular patterns to trade because there's a very clear breakout entry point for them. They often form at the end of trends, as these two examples that we've shown did. But they can also form at the beginning or partway through a trend. And the important thing to remember is that in classifying a wedge is that both trend lines must be converging, which means they're going closer together. You can see here, they are eventually going closer together, they're converging, and they must be pointing in the same direction, both ascending for a rising wedge and both descending for a falling wedge. So this is an example of a falling wedge as we just talked through, and you can see that both of these trend lines in the wedge are descending. That's what you expect to see for a falling wedge, and they would be the other way around. Both would be rising in a rising wedge. Also, remember to use the base of the wedge in taking the measured move price targets. This is the base, remember that point again. And using any other part of the wedge will produce a different and incorrect result. The best way to get comfortable with these patterns is to go looking through charts, experiment yourself and start identifying them.